You may have heard of the Magnificent Seven. That's Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta, and Tesla. I lost my crystal ball yesterday, but I'm here to tell you that you don't have to be a stock guru to get good returns. I'm Matt Callahan, CFP with Seaside Wealth Management. Let me show you how. So what we're looking at here are the returns for each of those stocks back in 2023. It's very impressive, right? Well, they could have easily gone the other way, which could have derailed your whole financial plan. So be careful when you're picking individual stocks. It's very hard, if not impossible, to consistently pick the stocks that are going to give you positive returns. If you simply would have put all your money in the S&P 500 index fund, which gives you exposure to the 500 largest companies in the US, you would have ended the year with 24.2%. I don't know about you, but I would take 24.2% all day, every day. And so this at least gives you exposure to 500 stocks and exponentially adds diversification over the 7 stocks like the Magnificent Seven. Let's take a look at how diversification can work for you and why adding international stock exposure to your portfolio might make a lot of sense. Remember, once you get retired, we want to keep you retired and happily retired. So here's a chart that illustrates the importance of international investing. We call it the Skittles Chart because you can see it just a random plethora of colors on here. And each one of these colors is a different asset class. And so you can see from 1999 to 2009, that was called the lost decade. Where I'm going with this is because during that time frame, the S&P 500 that we just talked about lost 1% per year. And so that's why we wanted to add diversification to your portfolio, because when the S&P is not doing well, hopefully your international stocks are working well and giving you the return that you're looking for. And so if we look further on this chart, from 1999 to 2013, you can see the annualized return for the S&P 500 was 4.68%. That means if you were taking 5% out of your portfolio over that time frame, you went back to work somewhere in 2015 or 2016. We don't want that to happen to you. So if you would like to explore how diversification can work for you and your portfolio to make your financial plan come to life, feel free to give me a call so we can discuss. I'm looking forward to helping you create peace around the issue of money.